Hi, everyone, and welcome to Crushing Land for this week. And happy to have you join us here as we discuss another topic when it comes to area selection. We're actually going to build off of what we talked about last week. Some of you reached out based on what you heard and what you listened to and putting that into practice and all of that. And you had a question about it based on information that you've heard from others out there. I'm assuming because you said, well, I've heard I should do X. And so here we're going to talk about that today. And that literally is targeting basically the hottest markets that there are. Some of you had reached out and said, like, I'm looking at these very hot markets because I've heard others say that I really want to go on to Zillow or Realtor.com or one of those type of sites, and I want to find a very hot market. And that is the area that I then want to target. And it's simply not panning out. Is that what I want to do? So targeting a hot market, at first glance, it may seem like the lucrative idea to do, right? It's something, it's obviously hot for a reason. And so you're like, okay, that's why I want to go there. But there's a number of different reasons why that is not the case. And so we're going to kind of break that down here today for a few minutes. So the first one, and the most obvious, is that there's high competition, right? The reason that it's hot is that there's a lot of investors in that area, right? There's a lot of people that are already working there. And so that's bringing the competition levels way up. That drives property prices up, and it makes it difficult to find a better deal because of that, or to get a property at a reasonable price or whatever it may be. So that higher competition that automatically happens from being in one of the hottest areas is something that is very quickly the number one negative thing that we face. But that's not the only negative that comes from it. Along with the higher competition, another thing that happens is the inventory numbers tend to go down in those areas for one of two reasons. Obviously, if we're talking about just vacant land and people aren't actually selling it, then the inventory is the same. Inventory is inventory, right? But you also have to look at it for how much of the inventory is actually on the market, as in being sold, what people are willing to sell, not necessarily actively on the market, but how much people are actually willing to sell. And while it may seem that when the market is the hottest, that people are they're going to be like, yes, absolutely, this is what I want to sell, that's not the case. What happens oftentimes is as the market is trending up and it's very hot, a lot of these sellers will sit there and they'll say, I'm going to wait, I'm going to hold back. I can see it trending this way, and so I'm going to try to get more. And that's usually what creates one of the busts that we've seen, the recessions and things like that. If you remember, if you were around or if you've studied or anything back, a number of years ago in 2008 or so, it was going up, 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 and everybody was always going to the next level, to the next level. I'm holding out for this, I'm holding out for this, I'm holding out for this. And eventually you get to a ceiling and it can't go any further. And that being the case, that's where there's some issues with that, right? So you have this limited inventory in that people themselves just simply are not willing to sell the properties, right? They're just not willing to go out there and let it go, even if it's at a good price, because they're sitting there and thinking, well, you know what, just in a few months or a year down the road or whatever, I'm going to be able to get even more for it, right? And so because of that, that turns into becoming harder to get properties yourself, and then from there being able to get a return on them by selling them, right? So when you're looking at those things, that higher competition, that does lead to that limited inventory that we're talking about. Again, the properties are out there, but inventory does mean that you have to have a willing seller. And if the seller is not willing to sell, then the inventory is down. And the other thing that happens that goes along with what I was just talking about is overvaluation on properties. What does that mean? It means that people are waiting, thinking that the next thing's going to happen, right? So their property is currently worth $100,000. But they're sitting there thinking, well, I've been watching this, and back at this date, it was only worth $50,000. So that means it's going to be worth $150,000 in the near future. And so I need to get more than $100,000 for it now. Right? So not only does it not work from the investment side of things, where you actually need to buy under market value, but it also doesn't work in the fact that they're not even looking at it from market value. They're looking at it from potential future market value that isn't given, right? Obviously, if there was a magic magic formula that we could look at, and we could sit there and we could say, wow, this property is 100% going to be worth $150,000 a year from now. That's worth 100 today. And they said, I'll take 110. You'd probably do that deal, right? Because you could make $40,000 in a year guaranteed. But there's no way of knowing that. There is absolutely no way. That property could be worth 100 in a year. It could be worth 70 in a year, or it could be worth more in a year. You just don't know. You know where the trends are heading, but nothing is guaranteed. So people will demand over actual value of their property because they think they see where it's heading, where it's trending, and that makes them want to do that, right? The other thing that happens that goes along with this, a fourth point here, that we see a lot, and we saw it again going back to 2008, when you're talking about these higher end markets, the highest markets out there, as far as the hottest markets, is that there's volatility in them. And what does that mean? It means that they're not stable, right? They've been climbing. That sounds great. It sounds great, and then it hits that ceiling, and then it's gonna go right down, right? And that's the way it always works. Now, it may not be a sharp drop like in other cases. It may just be a light drop. You don't know, but it's still not as stable. And when we go back to 2008, there was a lot of areas in the country where the market didn't do that. It was very much more like this as opposed to one of these. And that's what you see in the hottest markets. The hottest markets are the most volatile that you can be in. And so when you're dealing with things like that, it goes back to what I was talking about, where you don't know where things are going to be in a year, right? And so based on that, if that property let's go to 6 months instead. Let's say in 6 months that property that's $100,000 is now 110, or it's down to 90, or it's down to 80 or 120 or whatever it may be because of these fluctuations, right? If it's going down and you're at the higher end and you're demanding that, and the seller's demanding that, and you're paying that, and all of those things, then it's going to be a lot more volatile, and it's obviously going to be harder to move it, especially if it's volatile in the wrong direction, if it's dropping out from underneath you. So that's something that you need to watch out for. So we talked about, not going into these hottest markets for different reasons. We talked about highest competition, or higher competition, right? Highest competition. We talked about there being limited inventory. We talked about the overvaluation by sellers, and we talked about how the market itself is volatile. The last thing that I'm going to talk about is something that goes along with basically how long you've been doing this, how long you've looked at real estate investing, how much you've studied it, trends, and all of that. Because if somebody's only been doing this for a few years, they only know the hottest markets. And so even though there's different markets in the hottest markets, some are hotter than others, right? But the market was still good. So that being said, it's basically being dependent only on a single market condition. And when that happens, then it seems like, oh man, if I'm dependent on a single market condition where the market has been the best, where the things are amazing, things just sell. I get it under contract and I put it out there and I have an offer back that day. That type of thing. If that happens, then you're dependent on a single market condition. And if that's the case, obviously, I still wouldn't recommend going to the hottest market that there is. But even in the middle, they're still very hot, and you're still dealing with some of those things. But in reality, going into different types of markets and not being dependent on the conditions is a better scenario. It's a better investment strategy. And coming into land for a number of years now, working in an arena where the things weren't hot, where we came in and we were able to get properties very easily, but they were harder to sell. There was a whole lot less competition in that because it just wasn't as easy. It wasn't as sexy to people, right? It wasn't like, man, I'm going to get this thing signed and put it out there tomorrow and I'm going to sell it. So if you're only dependent on a single market condition, right, it ties your success in to that market. And so as that market is now shifting, as we're getting away from those hotter markets, and as the country overall is getting away from that, it means that you need to learn. And not diversifying means that your investments are going to suffer because of that. So again, that's where it goes back to what we talked about on the last episode, right? You have things here. You have things here where, there's still, we're not saying go to dying areas, right? We talked about growth. We talked about areas where some people live. We talked about things that you want to look at, but there's a difference between stable and booming, right? And so we never, ever, ever go into a booming area. It just doesn't make any sense. We go into stable areas, and there's tons of those all around the country, even now as we get ready, for, or as we're starting to see this transition phase. We're starting to see this transition phase here. We're starting to see the market cool. We're starting to see all of these different things. And even with that, we're still seeing these very stable markets. So while these hot markets may seem like they have the highest potential, right? They have the best returns, all of that, and that could be true if you get a great deal there. In reality, there's increased risks, there's increased challenges. So rather than going for the hottest markets possible, look for the stable ones when you're selecting an area, and you'll find out that your business as a whole will do much better, and it will be set for long-term investment success rather than just being contingent on a single market.